For more perspective, let's bring in Sal Guatieri, Director and Senior Economist at BMO Capital Markets. Sal, thanks so much for joining us this afternoon.
Welcome.
So what did you make of that headline rate coming in higher than expected? Instead of easing to 2.9%, just sticking with that 3.1 for another month in a row. Core inflation also, holding steady.
It is a mild disappointment. We were hoping, I think most of the market were hoping to see a two-handle once again on the inflation rate. And the core measures, the key ones, are still running in that 3.5% range. So there is still a little inflation pressure to wring out of the system. And a lot of that is simply in the shelter component. There's two areas there. One, mortgage interest costs. Mortgage payments we know will be reset at higher rates going forward, and that's going to be an ongoing source of upward pressure on the inflation rate for some time. The other is rent, still running in the 6-7% annual rate, and given the population numbers we saw this morning, I don't think we're going to see much relief on the rent side either. But once you look through those two areas, the shelter area in particular, things are at least moving in the right direction. I think that's the bottom line, that we've made a lot of progress from above 8% previous summer to now just above 3%, so a whole 5 percentage point drop in the inflation rate. And I think we're taking a lot more encouragement from the fact that on a shorter term basis, some of the key core measures now are sporting two handles on a 3-month basis. So definitely we're seeing some underlying softness and pressures, particularly on the goods side, but even on the services side now outside of shelter. So moving in the right direction, just at a slower and perhaps bumpier pace than some were hoping for.
Yeah, just how bumpy do you think the next couple of months could end up being? I mean, we know we heard from central bank officials over the past couple of months saying that there are ups and downs. This is normal when you're thinking about the trajectory for inflation coming down. But do you expect any particularly big bumps in the coming months?
Well, nothing moves in a straight line, and we've always held to the view that that last mile, getting all the way down to 2%, will take the longest time, and we still don't believe we'll get all the way back to 2% until late next year at probably the earliest. Because, I mean, generally, the labor market, it's softened, it's loosened a little bit in the last 6 months or so, but still running hot enough to keep wage growth running in the 4.5% range. So that's putting a little upward pressure on inflation. But overall, again, I think outside of the shelter area, we are seeing underlying softness, certainly in the goods sector, but also in broader services. So I think it's just a matter of time. Whenever you have an economy as weak as it is right now, remember, Canada's economy did contract the last quarter, and we don't believe we'll see much growth at all either this quarter or early next year. So when the economy is that weak, it can only open up so-called slack in the economy. Those wage pressures will fade and pricing power will fade on the part of businesses. It's almost certain that inflation will keep falling. Again, it's just a question of how long do we get all the way back to 2%. May take another year or so. Do
these latest numbers change anything for you when it comes to your forecast for rate cuts?
No, if anything, they kind of support our view that the Bank of Canada will hold off on cutting rates until perhaps June of next year. I know the market has moved ahead of us. They're building in earlier rate cuts than that. We still have 100 basis points of rate cuts in the second half of next year, basically. The market has moved a little ahead of that. But I think the message of this report for the Bank of Canada, and it pretty well backs up what the bank has been telling us, they probably don't want to rush into cutting interest rates and easing policy. They don't want to spark inflation pressures or fan inflation pressures once again. And again, until they're pretty confident that inflation is on that sustained downward course. It doesn't have to be at 2%, but it has to be on track to get towards 2%. They probably will hold off on cutting interest rates. At some point, they will have to cut rates, and well before we get to 2%, because as inflation falls, real interest rates are going up, policy is effectively tightening. They do have to neutralize that effect by trimming rates. And we think this report just confirms our general view that the bank will hold off on cutting rates until June of next year, but then we'll see perhaps a full 100 basis points of rate cuts through next year.